Good afternoon, everyone. So for today, I'm going to discuss about the pricing strategies and tactics. So successful pricing is a key element in the marketing mix. Many executives believe that developing a pricing capability is essential to business survival. They rank pricing as second only to the product variable in importance among the concerns of marketing managers. So what do we mean by price? So price is the only element of the marketing mix that generates revenue. All the other are costs. So price serves as a means of communication with the buyer by providing a basis for judging the attractiveness of the offer. The price should not be determined in isolation from the other marketing mix elements. And of course, in first-time pricing, there are alternatives. First, skimming. Second, market pricing. And the third, penetration pricing. The objective of the skimming is to achieve the highest possible contribution in a short time period. But if similar products already exist in the market pricing can be used. When penetration pricing is used, the product is offered at a low prices intended to generate volume sales and achieve high market shares. Let's go to the setting of export prices. So factors to be considered includes the following such as importance of price in customer decision making, in particular the ability to pay. Next, the strength of perceived price-quality relationship. Next, potential reactions to marketing mix manipulation by marketers. So for example, an exporter extending a first world product to an emerging market may find its potential unnecessarily limited and thus opt for a new version of a product that costs a fraction of the original version. So the customer's demands will also have to be considered in terms of support required by the intermediary. So pricing policies follow from the overall objectives of the firm for a particular target market. So the objective includes first, profit maximization, market share, survival percentage return on investment, and various competitive policies such as copying competitors' prices, following a competitor's prices, or pricing so as to discourage competitors from entering the market. There are three general price setting strategies in global marketing. First, setting a standard worldwide price. Next, dual pricing, which differentiates between domestic and export prices. And the third one, market differentiated pricing. So the two first methods are cost-oriented methods that are relatively simple to establish and easy to understand. While the third strategy, it is based on the demand orientation and thus may be more consistent with the marketing concept. So when we say standard worldwide price, it may be the same prices regardless of the buyer. So if foreign product or foreign marketing costs are negligible or may be based on average unit cost of fixed, variable, and export related costs. While the dual pricing, domestic and export prices are differentiated, and two approaches to pricing products for export are available: cost-driven and the market-driven method. So there are two approaches in dual pricing. It is the cost-driven and the market-driven methods. And the market-differentiated pricing calls for pricing exports according to the dynamic conditions of the marketplace. There are also export-related goods. These are the following. First, the cost of modifying the product for foreign markets. Second, operational costs of the export operation, such as the personnel, market research, additional shipping, and insurance costs, communication costs. And the last one, costs incurred in entering the foreign markets, such as the tariffs and taxes, risk associated with a buyer, and risk from dealing in other than the exporter's domestic currency. So the combined effect of both clear-cut and hidden costs result in export prices that far exceed domestic prices. So the cost is termed price escalation. Typical method for price escalations are the following. First, recognize the channel of distribution. Second, adapt the product. Third, use new or more economical tariff or tax classifications. Last, assemble or produce overseas. So, let's move on to the terms of sale. So, meron tayong tinatawag na Incoterms. These are the internationally accepted standard definitions for terms of sale set by the International Chamber and Commerce or the ICC since 1936. Tayong tinatawag na price-quoted exports or the EXW. So, this apply only at the point of origin and the seller agrees to place the goods at the disposal of the buyer at the specified place on the date stated or within a fixed period. So, all other charges are for the account of the buyer. Meron din tayong tinatawag na free carrier or the FCA. This replaced a variety of FOB terms for all modes of transportation except vessel. So FCA applies only at a designated island at a designated inland shipping point. So the seller is responsible for loading goods into the means of transportation, while the buyer is responsible for the subsequent expenses. Meron din tayong CPT. The seller's risk and responsibility for the condition of cargo and when the goods are delivered to the first carrier. So the seller must bear all transportation costs to the named destination and the buyer sides. Next, meron din tayong tinatawag na CIP. So, this indicates that the seller's risk and responsibility for the condition of the cargo and when the goods are delivered to the first carrier. So, the seller must bear all transportation costs to the named destination of the buyers on the buyer's side. So, the seller is responsible to provide insurance. Meron din tayong tinatawag na delivered at terminal or the DAT. This indicates that the seller's obligations ends when it has delivered the goods to the disposal of the buyer and they are unloaded from the arriving carrier at the named destination terminal, cleared for export but not cleared for import. Meron din tayong tinatawag na delivered at place or DAP. So this means that the seller's obligations ends when it has delivered the goods at the disposal of the buyer and the end of named destination place and they are cleared for export but not cleared for import. So the seller and the buyer should agree which party will be responsible for the unloading. Meron din tayong tinatawag na delivered duty paid or the DDP. So the sellers delivers the goods with import duties paid, including inland transportation from import point to the buyer's premises. Meron din tayong term na free alongside ship or the FAS. So at a named port of export means that the exporter quotes a price for the goods. So including charges for the delivery of goods alongside a vessel at the port. So the seller handles the cost of unloading and wharfage, loading, ocean transportation, and insurance are left to the buyer. Meron ding cost and freight or CFR. So, named Overseas Port of Import, the seller quotes a price for the goods including the cost of transportation to the named port of debarkation. So, the cost of insurance, and the choice of insurer are left to the buyer. Next term is insurance and freight, or the CIF. So, to a named overseas port of import, the seller quotes a price including insurance, all transportation, and miscellaneous charges to the point of debarkation from the vessel. So, if other than waterway transport is used, the terms are CPT or CIP. So there are benefits of taking charge of the transportation on either CIP or DDP basis. This includes the first, exporters can offer foreign buyer an easy to understand delivery cost for the deal. Second, by getting discounts on volume purchases for transportation services, exporters cut shipping costs and can offer lower overall prices to prospective buyers. Third, control of product quality and service is extended to transport, enabling the exporter to ensure that goods arrive at the buyer in good condition. And the last one, administrative procedure. These are cut for the both exporter and the buyer. Now let's go to the mode of payment. So export, credit, and terms add other dimension to the profitability of an export transactions. The exporter has in all likelihood already formulated a credit policy that determines the degree of risk the firm is willing to assume and the preferred selling terms. The main objective is to meet the importer's requirements without jeopardizing the firm's financial goals. So there are 5 factors in negotiating terms of payment. First, the amount of payment and the need for protection. Second, terms offered by competitors. Third, practices in the industry. Fourth, capacity for financing international transactions. And the last one, relative strength of the parties involved. So the most favorable term to the exporter is the cash in advance because it relieves the exporter of all risk that allows for immediate use of money. Meron din tayong tinatawag na letter of credit. So, a letter of credit is an instrument issued by a bank at the request of a buyer. So, the bank promises to pay a specified amount of money on presentation of documents stipulated in the letter of credit. Usually, the bill of lading, consular invoice, and a description of the goods. So letters of credit can be classified along 3 dimensions. So first, irrevocable versus revocable. So an irrevocable letter of credit can neither be cancelled nor modified without the consent of the beneficiary or the exporter, thus guaranteeing payment. So according to the new rules drawn by the ICC, all letters of credit are considered irrevocable unless otherwise stated. Second is confirmed versus unconfirmed. So the single best method of payment for the exporter in most cases is a confirmed, irrevocable letter of credit. So banks may also assume an advisory role. The last one or the third one is the revolving versus non-revolving. So most letter of credit are non-revolving. That is, they are valid for the one transaction only. In case of established relationships, a revolving letter of credit may be issued. Now let's move on to getting paid for exports. So the exporter needs to maximize the risk of not being paid if a transaction occurs. So the term commercial risk refers primarily to the insolvency of or protracted payment default by an overseas buyer. So in addition, non-commercial or political risk is completely beyond the control of either the buyer or the seller. So for example, the foreign buyer may be willing to pay, but the local government may use every trick in the book to delay payment as far into the future as possible. The following are the factors of assessment of a foreign private buyer. So first, credit reports may not reliable. Second, audited reports may not be available. Third, financial reports may have been prepared according to a different format. Next, many governments requires that assets be annually re-evaluated upward, which can distort result. Next, statements are in local currency. And the last, the buyer may have the financial resources in local currency but may be precluded from converting to dollars because of exchange controls and other government actions. So let's move on to managing foreign exchange risk. So meron tayong dalawang alternative, the pass-through and the absorption alternative or approach. When we say pass-through alternative, so in order for pass-through to work, customers have to have a high level of preference for the exporter's product. While the absorption approach, the increase in the price is absorbed into the margin of the product, possibly even resulting in a loss. The strategic response depends on market condition and may result in different strategies for each market or product. So this destination-specific adjustment of markup is in response to exchange rate changes have been referred to as pricing to market. So for example, a markup change will be more substantial in a price-sensitive market or product category. So beyond price manipulation, other adjustment strategies exist. This includes the following. First, market refocus. So if lower values of the target market currencies make exporting more difficult by, so for example, making collection times longer, marketers may start looking at other markets for growth. So in some cases, the emphasis may switch to the domestic market, where market share gained at the expense of export may be the most effective way to grow. The second adjustment strategies is the streamlined operations. So the marketer may start using more aggressive methods of collections, insisting on letters of credit, and insurance to guarantee payments. Third one is the shift in production. So especially when currency shifts are seen as long-term. So marketers will include or will increase direct investment. And din tayong tinatawag na commercial banks. So commercial banks around the world provide trade financing depending on the relationship with the exporter, the nature of the transaction, the country of the borrower, and the availability of export insurance. So this usually means that financing assistance is provided only to first-rate credit risks. Meron din tayong forfeiting and factoring. So forfeiting provides the exporter with cash at the time of the shipment. So in a typical forfeit deal, the importer pays the exporter with bills of exchange or promissory notes guaranteed by a leading bank in the importer's country. While the factoring, certain companies known as factoring houses may purchase an exporter's receivables for a discounted price. So factors not only buy receivables but also provide the exporter with a complete financial package that combines credit protection, accounts receivables, bookkeeping, and collection services to take away many of the challenges that come with doing business overseas. Pricing within individual market. So pricing within the individual markets in which the company operates in determined by first, corporate objectives, next costs, third, customer behavior and market conditions, fourth, market structure, and last, environmental constraints. So because all these factors vary among the countries in which the multinational corporation might have a presence, the pricing policy is under pressure to vary as well. Discuss the pricing within the individual markets in which the company operates is determined. So the first one kanina is the corporate objectives. So corporate objectives, global marketers must set and adjust their objective, both financial such as return on investment and marketing related such as maintaining or increasing market share based on the prevailing conditions in each of their markets. So pricing may will influence the overall strategic moves of the company as a whole. So pricing decisions will also vary depending on the pricing situation. So the basic first-time pricing, price adjustment, and the product line pricing, as discussed earlier, apply to pricing within the non-domestic situation as well. So demand and market factors. So demand will set a price selling in a given market. So despite the difficulties in obtaining data on foreign markets and forecasting potential demand, the global marketer must make judgments concerning the quantities that can be sold at different prices in each foreign market. So the global marketer must understand the price elasticity of consumer demand to determine the appropriate price level, especially if cost structures change. Next is the cost. Costs are frequently used as a basis for price determination, largely because they are easily measured and provide a floor under which prices cannot go in the long term. So, these costs includes the procurement, manufacturing, logistics, and marketing costs as well as overhead. There are strategies for thriving in these inflationary times, which includes the target pricing, in which efficiencies are sought in production and marketing to meet price-driven costing. Second is the value pricing to move away from coupons, discounts, and promotions to everyday lower price. Next, stripping down to produce or stripping down products to offer quality without all the frills. Fourth, adding value by introducing innovative products sold at a modest premium. And the last, getting close to a customer by using new technologies such as the internet and electronic data interchange to track their needs and company costs more closely. Structure and competition. So competition helps set the price within the parameters of cost and demand. So depending on the marketers objectives and competitive position, it may choose to compete directly on price or elect for non-price measure. So if a pricing response is sought, the marketer can offer bundled prices, for example, value deals on a combination of products or loyalty programs to insulate the firm from a price war. Last is the environmental constraints. So governments influence prices and pricing directly as well. So in addition to the policy measure, such as the tariffs and taxes, government may also elect to directly control price level. So once under price controls, the global marketer has to operate as it would in a regulated industry. So setting maximum prices has been defended primarily on political grounds. It stops inflation and an accelerating wage price spiral, and consumer want it. So the consumer wanted it. So let's go to the transfer pricing. So transfer pricing or the intra-corporate pricing. So it is the pricing of sales to members of the extended corporate family. So with rapid globalization and consolidation across borders, estimates have up to two-thirds of world trade taking place between related parties, including the shipments and transfers from parent company to affiliates, as well as trade between the alliance partners. So this means that the transfer pricing has to be managed in a world characterized by different tax rates, different foreign exchange rates, varying governmental regulations, and other economic and social challenges. So allocation of resources among the various units of the multinational corporation requires the central management of the corporation to establish the appropriate transfer price to achieve the following objectives. First, the competitiveness in the international marketplace. Next, reduction of taxes and tariffs. Next, management of cash flows. Next, minimization of foreign exchange risk. Next, avoidance of conflicts with home and host governments. And lastly, internal concerns such as goal congruence and motivation of subsidiary managers. Transfer prices can be based on costs or on market prices. Approach uses an internally calculated cost with a percentage markup added. So the market price approach is based on a established market selling price, and the products are usually sold at the price minus a discount to allow some margin of profit for the buying decisions or buying division. So in general, cost-based prices are easier to manipulate because the cost base itself may be any one of these three. So the full cost, the variable cost, or the marginal cost. Use of transfer prices achieve corporate objectives. So there are three philosophies of transfer pricing have emerged over time. First is the cost-based price, direct cost or cost plus, yeah. Second, market-based price, discounted dealer price derived from end market prices. And the third one is the arm's length price, or the price that unrelated parties would have reached on the same transactions. Finally, for transferring at cost is that it increased the profits of affiliates. Their profitability will eventually benefit the entire corporation. So in most cases, cost plus is used, requiring very marketing-oriented method because it takes local conditions into account. So while the arm's length prices is favored by many constituents such as governments to ensure proper intra-company pricing. However, the method becomes difficult when sales to outside parties do not occur in a product category. Of course, there are transfer pricing challenges. So, transfer pricing policies face two general types of challenges. So, the first is internal to the multinational corporation and concerns the motivation of those affected by the pricing policies of the corporation. The second, an external one, deals with a relation between the corporation and tax authorities in both the home country and the host countries. Counter trade. So, counter trade conditions that support such business activities are a lack of money, lack of value of money, lack of acceptability of money as an exchange medium, or greater ease of transaction by using goods. However, the shrinking of established markets and the existence of a substantial product surplus are also conditions that foster counter trade. Counter trade is also often viewed by firms and nations alike as an excellent mechanism to gain entry into new markets. So when a producer believes that marketing is not its strong suit or that international competition is too strong, it often sees counter trade as useful. The producer often hopes that the party receiving the goods will serve as a new distributor, opening up new international marketing channels and ultimately expanding the original market. Counter trade also can provide stability for long-term sales. So, for example, if a firm particular um, is tied to a counter trade agreement, it will need to source the product from particular supplier whether or not it wants to do. So this stability is often highly valued because it eliminates or at least reduces vast swings in demand. Another type of or another common form of counter trade is the buyback or compensation agreement. So one party agrees to supply technology or equipment that products or that enables the other party to produce goods with which the price of the supplied products or technology is repaid. A more refined form of barter aimed to reduce the effect of immediacy of the transaction is called the clearing arrangements. So here, the clearing accounts are established in which firms can deposit and withdraw the result of their counter trade activities. So these currencies merely represent purchasing power, however, and are not directly withdrawable in cash. So as a result, each party can agree in a single contract to purchase goods or services of a specified value. Another key form of barter arrangement is called the offset, so which is the industrial compensation mandated by government when purchasing defense-related goods and services in order to offset or counterbalance the effect of this purchase and the balance of payment. So offsets can include co-production, licensed production, a subcontractor production, technology transfer, or overseas investment. So typically, in order to secure the sale of military equipment, the selling companies have to offset the cost of the arms through investment in non-related industries. So that would be all, guys. I hope you learned something. I'm your reporter, Ronelyn Estaneo. Thank you for listening.